Hi, my name is John Aikman, and this is Hedge Funds Complete Guide. I am just giving you a quick update in 2020 in the midst of the COVID crisis. I think it was warranted, and so I got some questions from people about strategies and what's happening and why don't the markets make sense anymore. So I was just going to lay out some of the findings and some of the things to expect for the future or to think about as you're thinking about your own strategies. Um, Hedge funds in 2020, what's happening? Well, there's a retail investor boom during the coronavirus, caused by a lot of factors, including a lot of day traders sitting at home. And it's also stimulus driven, whereas we have what's known as a sovereign risk trade, where people are betting upon the impact of the Federal Reserve and other major central banks around the world providing stimulus to the economy. And that is something that people generally, when that happens, there is a general rule in Wall Street and all over the world that you don't fight the Fed, and that has been proven a little bit true from the lows that we had in March to now where we're into June, and we've recovered to some extent. At least the markets, the equity markets, have recovered. Lots of volatility, pretty choppy, but some strength in the markets. The question is for how long and how much further would this go. We may be looking at a reversion to some of the lows or even lower than that. So what are we talking about? Why are we thinking about hedge funds or alternative investments in general? And I think that there's probably a pretty good reason to think about them, where you're still having markets at extreme highs when we look at it from a historical perspective. And we also look at, the valuations in the equity markets, and on the other side, that bonds are effectively at close to zero right now. That the Fed rates is close to zero, and you also have negative rates in many jurisdictions, Germany, Japan, and elsewhere. And you're seeing massive government stimulus come in the European Union. So what does it mean for us? Well, let's look more specifically at what happened during the sell-off and this kind of bounce back. Well, we have had a pretty steep bounce back, but we've had a huge amount of government intervention and stimulus. I wouldn't necessarily categorize it as stimulus, more as survival modes, because you've had a huge spike in unemployment, huge challenges to the GDP of nations across the board. But that's what the chart looks like. The general, when we're looking at the S&P 500, the S&P 500 looks like it's had quite a bit of upside, and that's been pushed a large extent by the intervention of the Federal Reserve and other central banks to prop up some of the equity markets, prop up bonds, and even ETFs with junk bonds to some extent have been speculated upon by the central banks. Something that was previously thought of as verboten is now something that is really seems to be happening more and more, which is entering into more risk assets and looking for things like fallen angels, meaning companies that were on the edge of investment grade that have suddenly become non-investment grade. That was a major impact that happened with many ratings agencies downgrading lots of public companies and their bonds in the height of the COVID crisis in March, even in February 2020. So what's happening today? Well, we've still seen a massive growth and expansion globally of the COVID crisis. So this is the Johns Hopkins Coronavirus Resource Center, pretty good conservative source for information on coronavirus and the statistics associated with it. One of the challenges with monitoring coronavirus is really looking at whether or not we're getting realistic statistics, given that we have really varying levels of testing and varying levels of quality and reliability in terms of reporting of different cases. Some of them are really just focusing on some of the most seriously ill people, which gives an underlying um, misrepresented view on how many people actually have this condition. Very serious, very expensive, growing very fast, and it's been considered a pandemic. Uh, and the implications are that has gone global. It's in almost every nation and jurisdiction globally. Some of them, smaller ones, have been able to deal with it. Some of the larger ones have not. So the US, Brazil, Russia, UK, India, growing very, very fast. The US still growing, Brazil really dramatic increases there, as well as Russia and India. And China apparently able to quell that with the first one in, which clearly looks like had probably the lightest impact of this, that they understood what they were dealing with and cracked down pretty severely on the virus and on quarantines and mandatory quarantines for people, something that didn't really work for the other jurisdictions. So we can see that we have a really pretty significant growth in some of these areas. We have a significant growth of the virus, and the real question about what the future trajectory of this looks like, particularly for the United States, where right now it is the epicenter of the crisis, where we have many states where the numbers are still increasing, even though we're now coming out of the shutdown to help slow the curve of this vector or the virus. We have globally increasing daily new cases, so we're seeing expansion globally and a rise across the board, even as we're coming out of the quarantine and the shutdown of the economies in Europe and the United States and elsewhere. We're seeing that, in fact, cases are rising dramatically on a global scale. What's happening? Well, lots of people are day trading today. So we have people thinking that they're better investors than Warren Buffett. As the head of Barstool Sports believes he's a better investor than Warren Buffett. This was widely reported, and he quoted as saying, the easiest game there is. Real question about whether that will last. It's an easy game when things are all going up together, and that's not necessarily going to happen. We also have differing views on this, where we have Kyle Bass, a noted hedge fund manager, very successful manager who identified the subprime collapse, and his firm, Heyman Capital, making new positions on Hong Kong and the depreciation or the decoupling of the Hong Kong dollar from the US dollar. That he believes that that the currency board within Hong Kong is not going to be able to maintain the outflows of capital that are going to come from that area, where you see increasing tensions between Beijing and Hong Kong and the two-system regime, with a growing unrest in those areas. This hedge fund manager has taken on an event-driven approach to suggest that, in fact, there will be a major crisis in Hong Kong. One of the typically regarded as Asia's leading financial center. So obviously very, very big impact on that, and that could have dramatic impacts in the entire region and, in fact, the global financial system. So what else is happening? Well, COVID has damaged a variety of different industries, probably none as much as the airline stocks have really shut them down. And airlines, transportation, hotels have really been crippled by the current crisis. So these sectors have yet to recover, have yet to reopen. And we also see, in terms of the airplane manufacturers, growing cancellations in excess of orders being added. So you're seeing a growing, looming crisis in both the transportation and the industrial aspect of the transportation market. Also, this has impacts in the car industry and the manufacturers associated with that, where they are facing increasing challenges, where you're seeing the bankruptcy of Hertz, one of the largest buyers of some of those manufacturers' vehicles. When they go bankrupt, there's a knock-on effect that we can expect. And then how big is this in the background to think about? Well, the Bank of England has published certain reports on this, and most recently, the Bank of England warned that the UK was set to enter the worst recession for 300 years. So when we think about this, this is a gigantic crisis. It's pretty hard to even conceive of the numbers that were associated with this. The orders of magnitude larger that this current crisis is, even compared to 2008, much, much larger crisis, much more broad in its scope and in some of its depth. So the CBO, the bipartisan part of the US government, talks about the impact of COVID, and they expect COVID impacts to last for at least 10 years and very significant multi-trillion-dollar impacts to GDP for a very long time that people won't recover from. So what's happening as well? Well, we need to remember this in the context that this kind of started as, yes, we had a pandemic, which was at its infancy, wasn't really recognized. What people were really focused on was the impact on oil and this oil crisis that came up. Well, in 2020, we actually had a really strange situation where North American producers were the largest producers of oil in the world and had displaced Saudi Arabia and Russia and others. So when we think about that, the impact of that crisis, the dramatic drops in values from, even if you're at $20 a barrel, dropping down to negative $2 a barrel in terms of storage. And in fact, if you looked at the futures market, even worse when we think about it. So they were on the worst day, it was down negative $40 a barrel, having to do with the rolling over of certain futures contracts and the cost of storage as it was filling up. So people really not having a place to take it. That led to a huge number of tankers sitting in offshore waiting to unload their goods. So we had COVID-19, we had economic shutdowns, we had unemployment at record levels. So you're looking at huge increases in unemployment during this period, the fastest, largest increase ever. And you also have, the worst crisis from an unemployment setting or perspective in 2008, where you had 800,000 unemployed join the market in October of 2008. Now, actually, you have vastly more, into the millions, and the estimate is that there are over 40 million US persons unemployed. A massive hit in terms of the impact to the US GDP and the economy in general. This time really hitting many sectors, that energy and transportation, industrials, even real estate, and the commercial mortgage-backed securities massively impacted, automobiles. And then the one bright spot is technology, IT services rising. Why? Because people are trying to find alternative ways of getting work done. And some people have been successful in doing that. Notable cases: rise in Amazon, rise in Apple, rise in companies, newer startups like Zoom, leading to significant growth in that area. So IT, one of the bright spots in a very, very bad market. So some people are asking, well, what's the differences between 2008 and 2020? And I think that there's some important ones. When we think about it, 2008 was really focused on banks, financials, and near financials, insurance companies and others. It was the products that they're focused on really were subprime mortgages. That is, people who really couldn't afford mortgages being put into homes. And that had a knock-on effect in the structured products that were built, from mortgage-backed securities to even things like CDOs and more exotic products, and the derivatives that are based upon them. The epicenter of it was Lehman Brothers. That was the catalytic event that forced the recognition that this was actually a really big crisis, and that in fact there were going to be some major losses, and actually that the government wasn't going to prop up everyone. When Bear Stearns happened, people thought that there would just be another bailout. They would find a way to bail out Lehman Brothers. When that fell through, you ended up with a disorderly unwind of Lehman Brothers, and you ended up with a massive government intervention from TARP 1 and TARP 2, and you ended up with sovereign defaults leading to that ultimately, where Iceland directly went into default as its banking system collapsed. And then you also had, the larger European sovereign crisis that derived from the challenges within the global financial crisis, being Portugal, Italy, Ireland, Greece, and Spain. Now, today, what do we have? Well, we have COVID-19, we have an energy crisis, we have transportation crisis, retail has been devastated, you have major retailers going into bankruptcy, and you actually look at the numbers and the significance of those bankruptcies, it is massive today, even bigger than it has been before. And the hotels and restaurants really devastated by this crisis. Now, there have been impacts in terms of derivatives where we've seen incredibly volatile, strange markets that have created this global issue. So when remember that 2008 was really focused in certain areas. It was on US mortgages, and it was focused in certain financial centers, certain financial entities, whether that's AIG or some of the major banks. And you ultimately had the independent investment banks, the last remaining independent investment banks, registering as bank holding companies to face the Federal Reserve in order to face the Fed window and get financing from them to show that ultimately you were going to be safe by keeping your investments with Goldman Sachs and Morgan Stanley. So 2020, what's different? On top of all of the challenges we have, on top of the global nature of this crisis, what else is there? Well, overlaying all of this is that you have artificial intelligence and automation kicking in a way that we really didn't have before. That some of the numbers and the expectations about the jobs, blue-collar jobs and white-collar jobs that are going to be impacted and changed and even sometimes lost are very significant numbers associated with that. And we need to remember that this process of needing to retrain people in general, needing to upskill them or change their skilling for the new economy, this is already underway. We're already facing a challenge in this area. Now, the last part that we really need to think of is we're in June 2020, and the real question is there going to be a second wave associated with this? If there is a second wave associated with this, then the economic impacts are likely to be magnified significantly. So there's issues about reopening. Are we doing it too fast, too slow? Is it just right? Right now, people are taking very different approaches, and I don't think that the full evidence is in just now. It appears that many areas are opening too fast, that they haven't waited to control, they haven't had a proper monitoring system, contact tracing system, and also they lack the appropriate amount of testing facilities to even get access to it. And then you complement that on top of it, particularly in the United States and other locations, you have significant civil unrest related to George Floyd and the protests against police brutality. So what can we do? What should we be thinking about? Well, we do not have a crystal ball. As I said before in a talk I gave, we definitely don't have a crystal ball, but we do have history. And what if we are facing, the real question about the future and the future for the economy is, what if we face another wave of COVID-19? We seem to have managed to contain some of the health-related damage associated with COVID-19. We have limited the number of people that have been infected with this. But we should really think about what happened in the past. And one of the proxies that we have to think about, I mean, there have been probably 10 in the last 100 years or 110 plus years, there have been 10 pandemics. And of those pandemics, many of them had second and third waves. Of the major 5 that happened, they all had second waves. But the one that is most relevant for us is what's known as the Spanish flu. The Spanish flu in 1918 and 1919, almost 100 years ago, just 101 years ago when it came to Europe and the United States, is probably the one that we should focus on and think about. And this is what the Spanish flu looked like in terms of death and in terms of the impact on our society. So what we saw was an initial bump of 5 deaths per 1,000 persons, a very significant issue where we didn't have the same level of medicine. But at that time, what was happening was they had international transportation and mass migration related to the the First World War. And ultimately, what that led to was a migration and transfer of massive amounts of the virus globally, which expanded. And as you can see, it's not just a one-hit wonder, but actually you have the first hit, the second hit, which is 5 times as bad, and then the third hit, which is probably 2.5 times as bad as the first one. So if this virus, the COVID-19 virus, acts in the same way as others have in the past, then we should expect a very long fight associated with this. The ideas about getting the appropriate amount of vaccine and getting that to a large enough population to be able to mass produce it, very, very speculative at this point, and not at all clear to many of the scientists in the area that this is doable at all. Many of the virologists are very, very suspicious that this would be possible at all on the time frame that is being suggested by politicians and some other pundits. So be very skeptical of the easy offer that this will be fine simply because we're going to have a vaccine. There is no vaccine. In fact, if you look historically at something like SARS, there still is no vaccine for SARS. And we are not clear whether or not there will be multiple strains of this virus or how amenable it will be to a vaccine. And it may be that in fact we develop a vaccine, but the vaccine is actually only good for 1 season. So it becomes just like another flu vaccine, although much deadlier and much more damaging. So that is the outlook for this, and that's the ultimate question about what the impact will be for the future. The question will be, will this lead to another shutdown? Will this lead to another larger epidemic, and where hospitals are overrun? In certain parts of the United States, that is happening right now, as well as in many parts, unfortunately, around the world, where they're faced with very, very serious health system stresses. So why is the market up? Well, if you take this example, if you think you're a better investor than Warren Buffett and you are just a day trader, you're likely very foolish, and also you're likely very wrong that ultimately this will be proven to be wrong. And that you can think about this from a different perspective of recognizing that we have a very, very serious problem, that the economic impact has already been really devastating. According to many central banks, think tanks, the OECD, a variety of different sources suggest that this has been probably the biggest financial hit that the global GDP has ever faced. So think about it. You may not want to fight the market because maybe there will be. Maybe the rally will continue. But I think that Mark Twain's idea is probably accurate. Never argue with stupid people. They'll drag you down to their level and then beat you with experience. Probably true. You might not want to fight the market, but what should you be thinking about? What might you want to explore further in terms of alternative investments and in particular hedge fund strategies? Well, the strategies for 2020 that I'd be looking at very carefully would be distressed debt, alternative debt, still very, very important. Long short strategies, long some, short others, might be long tech, short airlines. Short bias strategies where you're really trying to identify weak companies. And then again, event driven. So think about the Heyman Capitals of the world, looking for these interesting global opportunities, looking for things known as fat tail strategies, similar to the 2008 strategies of some very, very successful hedge funds, might be John Paulson or others. And then we for a very long time, very successful strategy was short volatility. selling options that expired worthless, when in fact what we might be doing now is switching to that long vol strategy where we're seeing historically high levels of volatility, the VIX spiking very, very high. And then again, you may want to look at it from the perspective of the sovereign risk trade. Do you want to go with the central bank? Are there certain central banks that are weaker than others? Are there certain jurisdictions you might want to focus on from a global macro perspective? Some central banks have the ability to print their way out of problems. Others don't and have to go to the market. Now, some of those others are going to be facing challenges, particularly one of the hardest hit in Europe, Italy. There's a real question about the stimulus that will be required to bring Italy back on track and what the impact will be on its financial markets. So, thank you very much. This was the update for 2020 in June 2020. I hope you're all well and safe, and I hope you continue learning in this difficult time. So thanks very much.